Hello there and welcome to our webinar on understanding charity accounts. My name is Tracy Bird and I run the SCVO Trustee Network, which is sponsored by Rathbones, one of the leading charity investment managers in the UK, and their support enables us to offer these free sessions. So thank you for joining us today, and as you've just heard, this session will be recorded. And as we might cover some issues here that you'd like to ask follow-up questions about in a more confidential space, then do feel free to get in touch with us at info@scvo.scot afterwards. We'll send out all the slides to you after the webinar, plus links to further resources in a follow-up email. And as we're just getting started, can I encourage you to introduce yourselves in the chat and highlight any charity accounts questions and concerns you might have. So I'm delighted to be joined today by Jaslyn McGrath, who is a partner at Henderson Loggie and is also a charity trustee herself, and she's very kindly giving us her time and expertise today. Working on the SCVO Information Service and as a charity trustee myself, I think financial management and control is an area many of us struggle with. In lots of organisations, it gets left to the treasurer, which isn't good governance, as all trustees are collectively responsible for financial monitoring and decision making. So today, Jaslyn's going to take us through the fundamentals of charity accounting so we can hopefully all play our part on our boards as we should do. So as I said, use the chat as we go to ask questions, and we'll have time to cover these at the end. But right now I'm going to hand over to Jaslyn. Thank you.
Thanks, Tracy. Good to see so many of you on the call this afternoon. Can I just check, Tracy, can you do a thumbs up? You can see my slides. Excellent, excellent. Okay, so obviously Tracy's already done introductions. As she mentioned, my name is Jaslyn. I head up the Accounting and Business Solutions team here at Henderson Loggie, and we work with a wide variety of trustees and charities in the third sector space, and I am also on the board of 2 Edinburgh charities, so I can kind of see things from both sides, so hopefully I'll be bringing that to the table today. So just kind of a run through first of all of what we're going to cover. First up is trustees' responsibilities. Now, I know some of you on the call have potentially been trustees for some time, others might be new, or even contemplating becoming a trustee of a charity. So I just want to touch base on a couple of the responsibilities that you need to be aware of, and then how that links in to what we're going to be talking about today, which is financial management. Then I'm going to cover the different types of organisations, a quick overview for those who don't know that there are several different types of charity organisations, and then thresholds in terms of accounting and auditing requirements around them. Then we'll do a bit of a dive into the financial statements and hopefully give you some kind of tips on what to look at when you're reading financial statements and questions to ask. An overview of the different types of funds that there are in charities, and last but certainly not least is the trustees report, how important that is, the part it plays, and that will also cover reserves and the reserves policy and how we think about that and document it. So first up, the trustees' main duties. So these are by no means exhaustive, but things that we need to think about. So the first duty of a trustee is to ensure the charity is carrying out its purpose for public benefit. So is the charity doing what it was set out to do? And you as a trustee need to understand that. So as a trustee, you have to understand what is the charitable purpose. So hopefully those of you who are trustees have read the charity's governing document, because that will lay out exactly what the trust or the charity does. and it is good practice to ensure that each trustee has a copy of the current governing document, and that also when you join a charity, that you receive a full induction to the charity so that you understand your role. That's incredibly important, because if you don't understand what the charity does, then it's a little bit harder to read the accounts when they're presented to you. The second one is obviously another duty is to make sure that we are acting in the best interests of the charity. So the overriding duty of a trustee is to act in the best interests of the charity. And there are times where there might be conflicts between the charity and the trustee's own personal or business interests. But underlying it is very important that the trustees put the interests of the charity first. And that means you have to make balanced and informed decisions for both the long and the short term. The third is to act with reasonable care and skill. So a charity board should be made up of various different people with from mixed backgrounds and mixed skills. And so it's important that you use your skills to support the charity. And it's also important to know when you don't know the answer and where you might have to seek external advice. And as a trustee, I suppose part of what you do, as well as the skills that you bring, is to make sure that you bring enough time and energy to your role. I know, having being on the board of a number of trusts, that we have quarterly meetings, and I will get my board packs in advance of those meetings, and there's a lot to read through, but it's really important that as a trustee you prepare for those meetings. So do take the time to read those papers in advance so that you're ready to participate in those meetings and challenge the management board and also raise questions. As well as acting with reasonable care, and part of what links to the finances is making sure that at the beginning of a financial year, you as a board of trustees agree financial budgets, and during the course of the year, you manage the financial performance by looking at how you're performing against those budgets. Another duty, ensure that your charity is held accountable. So it is up to you as trustees to ensure that you comply with the correct statutory accounting and reporting requirements. Now, as a board, you may well delegate the responsibility of preparing the accounts and reporting to Oscar to either an internal finance director, treasurer, or an external accountant. But you must make sure that you understand what the requirements are and that you hold others accountable. And finally, make sure that you manage your trust, the charity's resources responsibly. So that means ensure that the assets of the charity are used for charitable purposes. We don't want to take inappropriate risks that might impact the assets or the reputation of the charity, and take care when you're investing and borrowing. So in terms of the day-to-day finances, as I said, maybe the charity treasurer or the FD ensures that adequate records are kept and that we review our policies, report on finance matters. But ultimately, it is your responsibility as trustees to have a level of understanding of the accounts and challenge appropriately. So that's probably what we're going to touch on today, give you a few things to think about. So a quick run through of the different types of charitable organisations that exist. Kind of touched on that already. So a few abbreviations that I'll probably use throughout this presentation. So for those of you who don't know, Oscar is the Scottish Charity Regulator, and that is who all Scottish charities must report to. So there are four main types of charitable organisations. There's what's known as an unincorporated charity. Now these are not legal, and unincorporated charity is not a legal entity, and therefore when you're entering into commercial contracts, trustees are effectively the parties to that contract. A charitable company, on the other hand, has limited liability for its trustees, and it's slightly different from an unincorporated charity in that respect. So there's limited liability, but there's also more compliance that has to be done, and as well as registered with Oscar, you are also registered with Companies House as a company. And then in more recent years, specific to Scottish charities is what's known as a SCVO, so that's a Scottish Charitable Incorporated Organisation. So like a charitable company, it gives the charitable trustees limited liability, but it's a little bit more flexible than a charitable company, and in that you do not need to comply with the Companies Act. And finally, a charitable trust. But today, I'm going to kind of focus on the top three, being the unincorporated charity, a charitable company, and the Scottish Charitable Incorporated Organisation. So how are they each governed? I'll actually just put all the kind of notes up there at the same time. So a charity, a charitable company, and a SCVO are all governed by you as trustees. But as a charitable company, you are also directors, and your information is available on public record on Companies House. As I mentioned, you should all be aware of the fact that each charity will have a trust deed and a constitution, and you should all be aware of what is in them, and hopefully should have read them. Again, a charitable company is slightly different, because as well as being governed by a trust deed and a constitution, they are also governed by a memorandum and articles of association. In terms of standards that we have to comply with, say the charity sort, which is the statement of a recommended practice, and that is the main legislation that governs all charities. And alongside that, we also have to comply with the FRS, which is the Financial Reporting Standards. So all three entities would report under the charity sort and FRS 102. And again, the Companies Act also has to, the charitable company also has to comply with the Companies Act. In terms of reporting requirements and who we report to, so all charities have to report to Oscar, as I mentioned, and this is done annually. So each charity will have a financial year end, many of which is March, some are also December, but charities can have any year end. So within 9 months of a year end, a charity has to submit an annual return to Oscar. And the annual return is a summary of information, some of which is in the annual accounts, information such as the number of trustees, the number of employees, what the charity does, total income and expenditure, and behind that, they also have to submit their annual accounts. And all of that has to be done within 9 months of the year end. A charitable company is slightly different in that, as well as submitting their accounts to Oscar, they also have to submit their accounts to Companies House, again, within 9 months of the year end. And then just to touch on at the bottom there, the other reporting requirement of a charitable company is a confirmation statement, and that's very similar to an annual return in some respects. It's an annual statement at a snapshot in time. of who the Director of Trustees are, details of the registered office, etc. So that's a little overview of the governing body. So in terms of accounting, there are two main ways in which charities can prepare their accounts. That's either on a receipts and payments basis or on an accruals basis. So for smaller charities, they can prepare what's known as a receipts and payments account. And I'll come on to the different thresholds in a minute. It's a much simpler set of accounts, and here you record your income and expenditure, as I've said, on a cash basis. So what income and what cash has come in during the year and what has gone out. So that's receipts and payments. An accruals basis is when you recognise income and expenditure for the period that it relates. So in this sense, for example, if your year end is March and you have received income in April from a local authority, which is quite often the case. So say City of Edinburgh Council, for example, gives you money in April, but actually that money was for your last quarter, it was for a grant for March, then that would be included in your accounts. So that's kind of the accruals basis. So it's income that actually relates to the period but may not have been received in that period. Another example, I suppose, is expenditure. If your accounts are audited, well, you probably haven't had the bill yet for your audit fee at the end of March, because that will be billed once the accounts have been finalised, but that work relates to that year and therefore should be included in those accounts. So that's the sort of difference between the accruals basis and the cash basis. So unincorporated charities and SCVOs do have an option, depending on their size, to prepare accounts on a receipts and payments basis, but companies must prepare their accounts on an accruals basis. So who can prepare receipts and payments accounts? So if a charity has income of less than 250,000, then they can prepare accounts on a receipts and payments basis, unless, of course, they're a company. Oscar provide a really nice, simple receipts and payments template on their website, which is really easy to complete. But if your income is over 250,000, then you would need to prepare accounts on an accruals basis, and they're slightly more involved. And then finally, for both receipts and payments and accruals basis, what I would say is, well, all charities are subject to some form of external scrutiny. And that's to make sure, obviously, that charities are spending the money as they should. And so either they are preparing accounts that are then subject to an independent examination or an audit. So if your income is over 500,000, then you are unable to have your accounts independently examined. You must have them audited. And also if your assets are over 3.26 million. So it's one or other. If they are either have income of over 500,000 or have gross assets of 3.26 million, then they need to be audited. So as I say, receipts and payments accounts are fairly straightforward, and what I'm going to sort of spend most of the time on for the remaining part of this session is really to talk about if we were doing an accrued set of accounts. Now, for those of you who are already trustees, obviously every charity is different, and depending on the size, your accounts might run from 20 pages to 100 pages. So it's where to start. How do you start looking at them? So I'm just going to touch on the main financial statements that you expect to see in a set of accounts. The first one is the trustees report, and I'm going to spend a bit more time talking about that later, because the trustees report is very important, and it really is a chance to tell the story of the charity in terms of the objectives and what's happened during the year, the achievements, and what's charity been doing. The second statement is your statement of financial activities, or your SOFA. So your SOFA summarises the income for the year and the expenditure for the year. So kind of thinking about that in kind of layman's terms, if you are an employee, for example, and you receive a salary at the end of every month, so that would be your income. So that's the money that you receive, your salary, that's your income. And then what you spend in a month, that could be, you might spend it on rent, on heat and light, motor expenses, going out for dinner. So all those costs are your expenditure, and a charity will have similar expenditure. And then at the end of the year, obviously, at the end of a month, you're hoping that you still have some money left over and you haven't overspent your pay packet. And charities are looking to do the same, to make sure that they haven't overspent their expenditure and compared to their income. And we'll do a bit of a deep dive into the SOFA shortly. The balance sheet is your third main financial statement, and it's a summary of the assets that are owned by the charity, and it also shows the liabilities that are due by the charity. So again, going back to you thinking about yourself, on a balance sheet, what you'd have is your asset. So if you own a flat or a house, that is deemed to be your asset because that's something that you own. And corresponding to that, you would have the liability, which is, for example, be your mortgage. And you would very much hope that your asset is worth more than your liability. And it's the same for a charity. Assets of the charity would be, again, they may well have invested in property. They might have invested in shares for which they receive dividends, or a charity's asset might just be the cash that they hold in the bank. Liabilities. Charities' liabilities usually consist of, at the end of the year, money that they're due to suppliers that they've not yet paid for, money that they're due to HMRC, for example, PAYE and NIC, so the taxes that they're due on their staff, and as I say, maybe the professional fees that they have not yet paid for. So it's a snapshot of a point in time at the year end of what assets are held and what liabilities, what a charity owes money to others. And the balance of that is the funds that a charity has available. And we'll come on to that shortly. And then the final statement is a cash flow statement, and charities who are required to be audited and therefore have income over 500,000 would also be required to prepare a cash flow statement. And that is, I suppose, what it says on the tin. It is a summary of the cash that's come in and out. So it's a reconciliation of what cash you had in your bank account at the beginning of the year, how the money's come in, how it's been spent, and what your cash balance at the end of the year is. And I describe all these four statements as pieces of a jigsaw, and you need all four pieces to really see the full picture of what's happening in a charity. So when you are reviewing these accounts, you need to look at all those statements to really get a full picture of where the charity's at and what questions that you should be asking. As I say, I'm not going to cover the balance sheet and the cash flow statement today, but what I am going to cover is what we should have included in trustees report, and what is a statement of financial activities, because that's the kind of biggest statement in the set of accounts, and there's lots of columns, and it's where do you start? So here's a bit of an example, a very simple example of a sofa. Now, depending on your charity, as I say, you look at that and it's just rows of columns, and where do you start? So first of all, I will admit that charity accounts are not that easy to read, and that is because it's a prescribed format that the charity SORP lays out how charity accounts have to be prepared, and that is what the SOFA shows. So first of all, looking at the column on the left-hand side, now these are, as I say, standard headings prescribed by the SORP, but behind that, that's why you have all those notes to the accounts, because it's those notes that really will help you understand what's in the income and expenditure, and help you see where the money's come in and where the money's been spent. So I'm gonna do a quick run through of the main headings first of all, and then we'll kind of look at the numbers. So in terms of your income, the sort of four main income headings are donations and legacies. So in here, you would expect to see general donations that a charity's received, either from individuals, corporate bodies, charitable trusts, and also grants that have maybe been received and are used in it for a general nature. Charitable activities, on the other hand, are grants that are contractual grants or performance-related grants. So there's a differential there, and it's making sure that you're putting the grants that you do receive into the correct box. Also under charitable activities is obviously if you are a charity that provide goods and services, then the income that you've earned from those goods and services. And then other trading activities, so this could be fundraising events that you've had and funds that you've received from those events. If you do hold property, for example, and you maybe sublet some of that property, then other trading activities would be the letting income. If you maybe run a small shop, that be a tuck shop or a charity shop that supports the work the charity does, then any income from that is kind of classed as trading income, and that would be there. And then the other type of income is investment income, and that's not only if the charity has shares and therefore income from investments, but also bank interest that a charity might receive on their cash. So those are the main sort of headings, as I say, that are prescribed by the SORP, but behind that you should all have notes to the accounts, and that should detail, I'll give you a more specific breakdown of what's actually included in that income, so that you can really start to build a picture of where the charity income has come from. In terms of expenditure, there's actually only two headings in the SOFA, and that's raising funds, expenditure from raising funds. So that's if you have raised funds through having a fundraising event, then what were the costs of that fundraising? Do you pay a fundraiser? So that would be their salary costs, or costs of hiring a call for your fundraising event. That would all go in there. Also the dividends, if you receive dividends, that's all the costs of incurring those dividends. So your portfolio management fees are also classed as a cost of raising funds. And pretty much everything else is kind of lumped in with charitable activities. So that's all the costs that are directly related to running the charity. So that might be, if you're a grant giving charity, that will be the grants that you pay to other charities. If you're an organisation providing goods or services, then it will be your staff costs and your overhead costs. So once you know what your income and expenditure is, as I say, the next is in terms, the next would be your net movement in funds. So that is, have you made a surplus or have you made a deficit? Ideally, anything in brackets is not good. So that means you've overspent, but that might mean that you've got funds in place to do that. And then which I'll come on to at the bottom, you've got your funds brought forward, and then your funds carried forward, which I'll come on to later. So that's a sort of, so on the left hand side is what your income and expenditure is. So we kind of now know that, and hopefully we've built up a picture of what our what types of income a charity has and what the types of expenditure are. And then if we skip the middle and then kind of jump over to the right hand side, that shows you the total. So that shows you the total income that you have received from donations, charitable activities, etc., both in your current year and in your prior year. So you should always have comparative figures. And it's really helpful when you're going down these columns as a trustee, when you're trying to read and understand the accounts, is, you know, where might there be variances? So in this example, we can see charitable activities last year, we received 5,000, whereas in this year we've received 25,000. So a question I would be asking the senior management team is, what's happened there? Can we go further into the accounts, and can you find the answer as to what's the reason for that? So this will help you build a picture of what's happened both in this year and last year. And then in the middle is your different funds. So your total income and expenditure in the year is then broken down into pockets. So you've got your pockets of different funds. And that's probably a good time to go and talk about that now. So what are the types of funds that are available? So when we talk about fund accounting, there are three main funds. You've got unrestricted, restricted, and endowment funds. So unrestricted fund is any income and expenditure that does not have a restriction attached to it. So if a charity is given income and there are no restrictions, and it's at the discretion of the trustees as to how that is spent, that sits in an unrestricted funds pot, and you can spend that obviously for charitable purposes in any way you wish. It's also possible from these unrestricted funds to designate part of that. So for example, if in the year a charity has received a large legacy, there are no specific restrictions attached to it, but the trustees can decide to put that money aside for a specific purpose. Then that is known as designating that money or ring fencing that money for a specific purpose. So it's sometimes a good way for charities to demonstrate how they intend to use the funds, and it can be helpful in explaining your reserves policy, which I'll come on to later. So a designated fund is when the trustees of the charity elect to put the money aside. And then you have a restricted fund. So this is where the donor, so whoever has granted you the money, where the donor has restricted the use of how that money is to be spent. And then the corresponding expenditure must be spent on that purpose. So an example might be you have either fundraised or you have applied for a grant for a particular purpose, whether that's setting up a well-being hub, for example, then where the funder has given you funds for that particular purpose, that is a restricted fund and a restricted income. and that goes into a restricted pot. And then any expenditure for that particular purpose is used against that pot.
Jocelyn, can I just ask, with the designated funds, can you then undesignate them if you want to spend them on something else?
Yes, yes, you can. Yes. So a designated fund, you have to designate within the year that you decide to designate, if that makes sense. So you can't do it post year end. So, you know, once maybe as a trustee you've looked at the accounts and decided that, oh, we should have put money aside for something, you can't do that. You have to designate within the financial year, and you document that within your board minutes. If over time you haven't spent all the money, or for whatever reason the money you decided the project that you decided to do it didn't go ahead, then yes, you can reallocate that to unrestricted, and that's slightly different from a restricted fund. Whereas if you haven't spent all the money, then you often have to go back to the donor, and they either may request for that surplus to be returned to them, or they may grant you the surplus of that to be unrestricted and used for a particular purpose. But you'd have to request that from the donor.
Thanks.
And the other fund, just to touch on, is the endowment fund, and that is usually refers to a form of investment. So where you're given an endowment of investments, again, that's a separate fund, and the income generated from that, usually dividends, has to be spent on the furtherance of the charity's activities. And usually the investments are kept in that form. They can't be released for any other purpose, but that doesn't mean you can't buy and sell investments. So you can sell just as long as you're reinvesting them in further investments. So those are different types of funds. And then just kind of going back to my examples, that's what you'll see there. So once you've got your total income, you'll have money that has been given for a restricted purpose and money that's been given for an unrestricted purpose. So once you've got your total income, you're then putting it into the different pockets, and so it's important to look at that as well, because at the end of the year, that's what forms your reserves that you have available. So I'll use that here, just a quick example. So here's an example of, as I say, once you've looked at your SOFA and you've got all the notes that underpin that, which show you the different types of, all the notes give you more detail on what's in your income and expenditure. You've also should have a funds note, and that details all the different pockets of funds that you have. So once you've got a restricted fund, but you could have lots of them. So in this example, we've got a charity who received money for minibuses and equipment specifically to be used for that. They also had another restricted fund for COVID equipment, and one for an office refurbishment. So there were several different funds there, and you have to track each fund and then how each of that money has been spent. And it's quite often that maybe money will have been given that you haven't spent it all in the year. That could be because it's a long-term grant that's lasting over 3 years, or it could just be that, you know, for timing, depending on when the grant received. So it's not always the case that the money you receive in a year will always be spent in that year. But we would expect it to be spent over maybe between 1 and 3 years. So you will have a balance left at the end of the year on your restricted funds. And then you'll have another pocket of fund being your general fund or your unrestricted fund as well. And then as well as that note, which breaks down how all the different funds you have, you also need to have narrative, which explains what each fund relates to and describes the nature and the purpose of each fund. So reading the accounts, I probably kind of touched on this already, but a couple of questions. So when you're looking at that SOFA and you're looking at the what's happened in this year compared to last year, things to question. Do you understand the income streams of the charity? And are they what you expect them to be? So for example, if you're a charity that's mainly gets its income from one source, like local authority, is that captured in the accounts? Is that what you expect? And if you are heavily reliant on one source of income, is that a risk? And is there a need to diversify? So something to think about. What are the reasons for the fluctuations in the income, both comparing to last year, but also thinking about those budgets that as trustees you signed off at the beginning of the year? How are the figures looking compared to what was budgeted? What are the key items of expenditure for the charity? Do you understand that? And are they what you expect? If staff costs have gone up dramatically, why is that? We're obviously seeing charities who have property, for example, with fuel cost rising, a big increase in heat and light. So it's thinking about the commerciality as well, and what's happening in the marketplace, and is that what's expected? And if there has been significant key items of expenditure, are we managing that? Do we have enough income to cover what we want to spend? And if not, what are we doing about it? So again, looking at those variances, and is there anything unusual that you maybe want to challenge the senior management team about? And again, reasons for surplus or deficit. Obviously, reasons for the deficit you really want to understand. You want to understand why in 1 year a charity might have overspent compared to what their income is. But the flip side of that is, have they underspent? Do they have a big surplus? And why is that? And there could be lots of reasons for it. As I say, it could be a 3-year grant, for example, that just hasn't been spent yet. Or it could, could questions be around, are they not using the funds for charitable purposes? And how much free reserves does a charity hold? And that's what I'm going to kind of come on to next. So these are just a couple of questions. And I think it's really important that when you're looking at a set of charity accounts, remember, you probably don't have the answers. That's where the senior management team should have the answers. But you should be able to be prepared to ask questions and challenge the management team. So the trustees report. Now, I suppose the title is what it says. It's a trustees report. Your auditor, your independent examiner should not be writing this report. You as trustees should be writing this report. And a good trustees report really explains what the charity is set out to do. And it really is an important part of showcasing. It's your opportunity to showcase what's been achieved and what's been happening in the last year of the charity. So again, there are certain requirements that the SORP lays out and certain headings that most charities should prepare their trustees under these headings. So objectives and activities, obviously again sets out the main objectives of the charity, which should coincide with what's in their governing documents, what activities you perform, and what are the achievements, what's happened in the last year. And it's really important that the trustees report, this narrative is bringing your numbers to life. So we talked just a minute ago there about the different funds. So it could be different projects that you're working on, and that funds note should really mirror then what you've said in your trustees report. So if you're talking about your achievements of your different projects you've been working on, any reader of the account should be able to see, how is that then reflected in your numbers? You also, depending on the size of the charity, smaller charities don't have to, but again, recommended to, is talk about your future plans, as well as what's happened in the year, what are your plans for the future? A very brief overview of the financial review. So maybe again, just touch on your income for the year, what's happened, what's your expenditure, why have you made a surplus or a deficit? Again, just explaining the numbers in the accounts. You also need to document your structure, governance and management. And that is, again, what is your governing body? Is it articles of association? Is it a trust deed? Who are the management of the team? What is good points of good governance? For example, what does your trustees induction look like? How do you induct your trustees into the organisation? And who are your key management personnel as well? References and administrative details. So that's who are your trustees, who are your independent examiners, your auditors, maybe your lawyers or your investment manager details are put there as well. And something that's really important is obviously make sure you explain your reserves policy, and that's what's included in your trustees report. So what is your reserves policy? So as we say, we've got different pockets of funds. Your restricted fund is for specific purposes. So if you have a restricted fund at the end of the year, that's ring fenced for specific projects. But your unrestricted fund, part of that is what makes up your reserves policy. So what free reserves do you have to spend? And you need to explain why you have that balance at the end of a year. So there's a misconception, I think, that a charity should have between 3 and 6 months reserves at the end of a year. That's not the case. Every charity is different, and therefore your policy as to why you hold those free reserves, it has to be explained. And a reserves policy explains to existing funders and potential funders, donors and other stakeholders why you're holding that money. And a good reserves policy gives confidence that the charity's finances are maintained properly. So it's a very fine balance. If you hold too much reserves, then if you're going out and you're looking for funding, then funders might come back and say, well, you've got a lot of unrestricted free reserves. Why do you need any more money? And so it's important that your reserve policy explains that. And part of that could be that, well, you've designated money for a particular purpose. But also at the same time, it's important to have free reserves because we don't know what's going to happen. For example, during COVID times, suddenly some services for some charities stopped, but you still had to pay your staff, you still had to pay rent on premises. So it's important to have that safety net that, for various purposes. So there's no right or wrong as to what you should have, but what's important is explaining it. So the trustees report is a really, really important part of the document. It's probably the longest part of the financial statements, but it really is a chance to really showcase what great work your charity has done. But it's important that it reflects the numbers, and they should go hand in hand. Hopefully that's given you something to think about and some food for thought. I'm happy to answer any questions, Tracy.
Thanks, Jaslyn. There's no questions up to now in the chat, and I would encourage you to put some in there while we've got Jaslyn and her expertise. While you're thinking of anything, I was just going to ask Jaslyn, we had a question a few weeks ago on the role of members in either approving the annual accounts, or do they just consider them at the AGM? Who is it that approves the accounts? Is it the trustees? Is it the members? Does it depend on your constitution?
Yeah, I mean, I suppose in part it does depend on your constitution, but really it's the trustees. It's their responsibility to approve the accounts. But obviously, it's always good governance to let your members have a look at the accounts. So it is the trustees, and they might well approve and sign the accounts in advance of any AGM, but certainly the members should have access to the financial information. And quite often, yes, usually as part of their AGM, the numbers are presented to you.
Great, thank you. That was a really good presentation. I learned a lot from that. Yes,